Hi, and welcome to the BizOps 101 course. We're going to be going through the slideshow today and informing you about the most frequently ran into things that agents do when listing business opportunities, keeping you out of trouble, reducing liabilities, and stuff like that so that you can really learn something and take it back to the field and use it. So the first thing, as you can see on the slide, is things you have to know about your clients. So one of the most important things is why you're here today. Most of you are here today either because you have been thinking about doing business opportunities, or you have done some and have run into difficulties or would like to do them better. One of the things in the complex world of business opportunities that we all run into is dealing with the clients that are a little different and working with an entity that is worth only that much as the business books are, and those are really hard to identify or analyze. So one of the things that we will learn today is how to deal with those two things. The high risk of liability risk we have with business opportunities is also important because of the fact that this is one of those fields where people tend to sue each other more frequently than any other type of businesses real estate agents or business opportunity agents are faced with. Well, we got, as you see, business buyers and business sellers, and depending on which side you're sitting or representing, it depends also how you're going to handle that. Business buyers are a separate feed, and one of the key things that you need to remember is that business buyers would like to buy a business unless they specifically ask you to represent them in the acquisition of a specific business. Most of the business buyers end up, or 80% of them ending up buying a business they did not intend to buy. They never thought of buying, and you have presented them the opportunity and they have seen themselves owning that business. So one of the things that you have to be able to do is identify their needs, and that's as difficult as it is when helping out a home buyer. You need to figure out how to represent a business buyer by knowing what their needs are. Business sellers on the other side, and we'll talk about this as a matter of fact in a moment. On the other hand, business sellers have a child to sell. So they created something, call it a child. Their child is their business, and definitely they see the value of that business far more valuable than somebody who is buying it. And one of the key things that we should look at when representing business sellers is making sure that we want to represent that business seller, because most frequently you don't want to get involved with that business because it will never sell at the terms that the business seller is asking initially. So, having said all this as an intro, let's see and understand the person behind the deal and leveling the playground. One of the key things is understanding on both ends, buyer or seller, all the things that are driving that person to do business with you. So let's talk about the business, the age of the client. Let's talk about the business itself, the reasons why the seller is selling the business, the reason why the buyer is buying, what their expectations are. Those are all very important things to understand before we ever get involved. So I'm going to cover most of those things throughout the next few steps, and that is the vocabulary. So if we were to, in this short course, figure out the main things in the vocabulary, we'll also find out the main things that are driving the buyer and seller and identify those. So let's start with the term bulk sale or asset sale versus stock sale. Just to give you a hint right away that unless the the corporation is sold as a stock sale, 100%, you do not want to get involved with it because it becomes a security sale. So you got to find out first if it's a corporation, sole proprietorship, partnership, or whatever type of entity, and identify who's selling the business. Most often, new and unexperienced brokers end up finding out too late that the real owner of the business is actually not the person they're talking to, and that this person does not have the right to sell the business. So unless it is a business owned, and you got to do your research, unless it's a business owned by that person you're talking with, you got to find out who the decision maker is and talk to them. Or if it's a corporation, the key thing and the first thing you want to do is get a resolution of sale from that corporation. Even if it's a one-person corporation, the corporation's got to give you a letter identifying that the business is for sale and that you are the business broker and that you will be talking to whoever the secretary of the corporation or the person signing that corporate resolution identifies as a person you will talk to. So that's like a good point to start. So now we're talking about if it's a corporation that you can sell a 100% asset sale, whether it's an asset sale or a stock sale, and if it's an asset sale, how we're going to go about it. So, asset sale means at one point of time the business will close in escrow, it will terminate, it will cease to exist. All the paperwork tied into the government will be closed, and you as the owner or the purchaser of the business will inherit the assets. So asset or bulk sale, that's it. If it's a stock sale, it will transparently transfer to you, and there'll be no major complications in writing the paper up, but you will be inheriting all the liabilities of the previous corporation as well. So transparency means everything goes through. So if there was any tendency of a lawsuit or something happened 3-4 years ago and it's boiling to just bite you, you would not know that. And there's certain risk tied into that. That's why stock sales are tied into corporations that have a pretty clean record, and where it's worth buying the corporation as is with all its liabilities and taking the chance of having that lawsuit, which might not be that bad of a deal if you're getting a good deal in a corporation. Business valuation, one of the things that you will be talking very frequently, regardless of whether you get the listing or not, is one of those things that most people tend to use rule of thumbs. A rule of thumb, for example, there's many evaluations. There's 4 that we use in our business, and we value the business as an average of the 4 methods. But one of the key things is rule of thumb and multipliers, business multipliers, which can be found, which are not easy to find, but if you're doing business opportunities, you would definitely get by the tools that could get you those two. Most frequently, people use just common denominators, which are really way off and do not really indicate the real value of the business, and they use like a 3 multiplier for restaurants, even though those multipliers are based on the specific business, on the demographics, area, type of business, number of employees, ease of replacement, all those little factors, about 15 of them, and those multipliers are then used to multiply the net income, or the seller's discretionary income, as we call them, and we'll get to that in a moment. Or a rule of thumb, which would be like a comp on real estate. We would know approximately what the businesses of that kind are going in that area or part of the country, and we would use that to figure out what this business would be worth. Those are really top, like shooting from the hip type of valuations. However, for the real valuations and people that would like to get real valuations of the businesses, there is tools, and they're not very expensive. You can buy and do that right. Now, gross revenues are obviously sales. So gross revenues are sales, and those sale numbers can be, if you hear anybody using the word EBITDA, EBTDA, those numbers are usually used in stock sales, or for corporations that have accounting systems that are complex and do use that as a number. However, for most of the small mom and pop businesses, or businesses that you would rather run into on day-to-day basis, we're using discretionary cash flow, or what the owner takes home. And those numbers are obviously adjusted numbers from any type of books they have. Getting down to the bottom line, it would actually be asking, okay, how much do you take home to pay for your bills, for your kids, for your house, for your cars, and all that, insurance and so on. And that number would be used to multiply, to get multiplier value of the business. Then we have the SDE we just mentioned. The P&L, profit and loss statement, and the balance sheet are two things that would be really nice if you get at any point, at the very beginning of talking about business valuation or listing the business. Profit and loss statement gives you the cash flow, gives you the cash flow for a period of time. You should get profit and loss statements for the previous year and year to date. You should also get 2 or 3 years of tax returns, which will really not tell you the actual numbers, but those reported to the government. So if you're selling to a corporation or a serious buyer, most frequently, because tax numbers are reported numbers, they would go by those, which would really shoot the business value down, or the purchase price down, let's say. And that will be that the seller has shot himself in the foot by not reporting all the numbers. So when buyers are buying off the other set of books, or non-reported revenues, or potential numbers that are claimed by the seller, they have the right to discount that business for the value that is not reported. Okay, yeah, sure, it's worth more because you claim more numbers, but I don't see them on the books, so I'll have to discount you that price. And sellers don't like that. They would, of course, they feel good about their business, or they feel that their business is worth more, so they would actually just not want to sell it to that buyer, which would make it very difficult for you to make a commission, wouldn't it? Now, the balance sheet is obviously a value of the business if they were doing good accounting and all the equipment was on the books, and the balance sheet and all the capital was on the books, and then it would show you how much value it has on the books. Lease terms, golly, so important. Lease terms. I know a lot of businesses today that are valued very low and should sell like cookies if it wasn't for the bad lease terms. So one of the key ingredients for choosing whether you will list a business, or if you're representing a buyer, whether the business is right for them, is the lease terms. So you got in your lease terms the amount of years left on the lease, any options that they can execute, what the monthly rent is it a triple net lease, is it a modified gross lease, and how it affects the business, how many square feet are there, and what the total lease amount is. I have restaurants being sold for $30,000 as a business where the equipment is worth $100,000, but the lease terms are so unfavorable that they're actually consuming more than 30% of the sales, that revenue that restaurant can produce. So of course, if you can make the business, or if your buyer can make that business thrive and make a lot of money, any lease is a good lease. But if they're taking over a business and do not have a clear concept, that lease can just eat their business up, just like it is eating the seller's business up. So lease terms are very important. One of the key things is whether the landlord will assign or the lease or sign a new lease with a buyer. And that I like to find out before we would ever enter escrow, so we don't kind of spin our wheels. I would qualify my buyer with the landlord before, sometimes even before we would make an offer to the business, because you would be amazed how many landlords actually have secrets that they can actually share with you to negotiate a much better deal, and sometimes to take over the business without paying for the business. Now, if you want to know more about that you will have to go into my advanced class. But those are options, and a lot of them rise out of the negotiations with the landlord to start with. Inventory. Some businesses are heavy on inventory, and you need to kind of know about inventory. I suggest always, if the business is heavy on inventory, seller or buyer representation, I would suggest a third party coming in and counting the inventory at the beginning of the escrow and the end of the escrow and signing off on the inventory balance. Definitely pays off. FF&Es. A lot of people are curious what FF&Es are. Furniture, fixtures, and equipment is everything that you're buying with the business, and most of the asset sales are bought on those bases. So when you're listing the business, you need to have the seller write a very nice and specific furniture, fixtures, and equipment list. Separate furnitures and fixtures, separate equipment, and put some values next to each of those so that will go into escrow, and that is exactly what the buyer will ask to see when they are making an offer. Goodwill. You're familiar with that word, and that is a word that's been tossed around quite heavily without anybody understanding the real value of goodwill. Goodwill can be valued in anything, and most frequently goodwill is used to offset some of those furniture, fixtures, equipment values to the value of what the business is being purchased for. Just get a mental picture, goodwill would be any value that the business would have if you were to buy it that would automatically create revenues. So regardless of who the owner is or where the business is, even if it relocates into another location, that goodwill should create value just on the basis of the name and the products it sells. So the arch is the goodwill value of McDonald's. Anywhere you open the McDonald's and put the arch and the name, you can expect certain revenues just based on that. If the business you're buying has any goodwill, that goodwill should be identified and the value should be there. If there's no value in the goodwill, or if you're buying a business and changing its concept, there's no goodwill. Of course, in the escrow, you will be advised to put some number there because you need to spread out the purchase price against certain things like furniture, fixture, and equipment, and goodwill, and some other things that we can learn in an advanced course. Let's see what else. NDA, non-disclosure agreement. That's very important for you if you are selling the business. That's where a lot of liability comes in, and that's where real estate agents dealing with business opportunities are really bad at. One of the things that you all might be familiar with, that if you're using MLS system and you're listing your business opportunities on it, MLSs usually require you to put in the address of the business and some other data that your confidentiality with the business you're listing does not allow. But the MLS does not allow you not putting the address in there. So if you go to any MLS like the Carrot system and look into your businesses to the businesses people have listed, it's free for all. Businesses are listed by address or by name. And that pretty much is a lawsuit just waiting to happen. Now, I know that if you're listening to this and you have listed a business like that you're freaking out, and you should. But the fact is that if that business owner loses the business based on the fact that it is interrupted by potential buyers that do not have respect for privacy and confidentiality, then he might be losing the business. And if he is at any point of being endangered to lose his business because of that, he will come after you. Period. So, NDA, non-disclosure agreement, or frequently called non-disclosure and confidentiality agreement, is a piece of paper that you should have every single buyer sign before you disclose any information on the business, including the address and the name of the business you're selling. So if you don't know NDA, no information. A lot of people just can't deal with this, so they give the name of the business like, oh, I trust you that you will not kind of go and bother those clients, those owners, or the cook, or the workers in the business. But what happens, people do. When I was unexperienced, I've given that information, confidential information without the NDA, to my colleagues, and they would go in and start talking to the employees or someone about it, and it was just a mess. So don't do that. That would be on the vocabulary side. Now, specifically on the seller, we'll kind of start to wrap this up rather quickly, but representing the seller, you got to find out what's being sold. The key thing is when the seller contacts you and asks you to represent him, you ask him, what are you selling? They'll say, well, this business. Well, specifically, what are you selling? What are you selling, the name or the business or the revenue, the income? And quite frequently in a small business, you'll find out these days that there's really no income to sell. And if they don't disclose to you, you will need to find out why they're selling, and you'll find out that even though they'll not tell you, it's the income. Why are they selling? So I believe personally that there's only two good reasons to sell a business. And that's unfortunately a death of the owner of the business. And in which case it's a legitimate reason to sell the business. It could be a thriving business that the family cannot handle, so they're looking for a buyer. Or some other distress, divorce in the family. Usually divorce will be because of a sale of business, of a good business. Let me see. I cannot think of really any other good reason why a business will be sold other than that. All other, whatever the excuses are, is it's not making money. So if the business is making money, people hold on to it unless they have those two unfortunate happenings in their life. Otherwise, it's all the money. So if it's being sold, it's not making enough money to make someone happy. So when that type of seller tells you that there is potential in the business, never be suckered into believing that that potential should be sold or be part of the value, which they do want to make part of the value. So, saying that this business has potential, that's why we're asking $100,000, is actually not a good way to go. You have to definitely step hard and say that the potential of the business is the value that the buyer will bring to the business, and it cannot be sold to the buyer. If there's potential, the seller should make that potential happen and sell it as a thriving business. How quickly do they want to sell the business? If they're looking if the business is worth about $60,000 or $100,000 based on comps of similar businesses in the market that have been listed recently, then they should list it at that price. If it's above that price, it's not going to sell until those other businesses sell. Similar like houses. If you're a buyer and you're trying to buy a business, you're looking at all the businesses that are for sale. So if they have a kitchen and they're not making money across the board, the buyer will go after the business that has the best location and the best potential for the same price. If your business is above that price, they will not buy that one. As I said, what is a seller? Sole proprietor, partner, a corporation. You got to identify that. How much are they looking for the business? Are they willing to carry back a certain amount of money? So one of the key things is when there's no financing available and the business is a good business, it will not be sold without the owner carrying back a loan. So that is one thing that you have to figure out right in the beginning. If it's a bad business, nobody will carry a loan. They'll just like to kind of screw someone over or sell it to them and bail without ever being found. And that would be if they would to find someone to be suckered into buying such a business for much money and based on false information. However, if it's a good business and it has good books, then there's absolutely no reason why the seller wouldn't carry a note back, a loan, and maybe even be on the board of that business, on board with that business for maybe 2 years or the length of that loan, and ensure that the transition is good, that the buyer floats with the business well, and that the revenues are growing from then on, and then step off when he's paid off. A very reasonable and frequent scenario. Revenues, of course, you need to kind of make sure that the revenues or the income of that business is coming, that there's enough sales. The discretionary income is that income that the seller is taking home. So even though the books could be clean, and that all revenues and expenses are going through the books, expenses will definitely, but revenues, you have to make sure that there is an adjustment made for all those things that the buyer will not consider something doing it. So if the seller is carrying insurance for the vehicles that their kids are driving, or health insurance, or certain trips and that they're making that are personal nature but going on the books as the business, those things have to be discussed and have to be adjusted back because they will increase the selling price. If those things are adjusted on the books and they're showing on your listing as income, as discretionary cash flow, as something that increased that number, your business that you're selling will have larger value because the multipliers will use a higher number. Rent amount, lease contract, those two you want to have. Do not leave that for the end. When you are listing the business, you want to have a copy of the lease contract in your hands before you list the business. You want to see that, review it, see if the landlord allows the selling of the business to start with. See it with your own eyes, read it, don't take it for granted or seller said. The books, if there's 2 sets of books, you want to have your hands on both. You want to see those. Then we have the buyer's things that you need to cover, and that is knowing the buyer's background, knowing whether the buyer is interested to buy and why they're driven to buy the type of business they claim they would like to buy. How much money down are they willing to put, or do they have? And here's the catchy part. Most agents I've seen working the business opportunities do not confirm funds before they take the listing or immediately after they take the listing. You got to see that money, that proof of that money. You would go after that proof when making an offer on a house. So why not have proof of those funds when buying a business? If your buyer is not giving you proof of funds that they have on hand, they're not trusting you, and you need trust to be able to close a business opportunity deal and make a commission. So answer yourself the question, do you want to make a commission? And if the answer is yes, then get all the things right, including the funds that they have. If they're counting, I usually kind of go after the funds. So there is a spreadsheet that I use that you can learn about in the advanced course. But if they're having $200,000 all together to spend on purchasing the business, there's no reason why you wouldn't look for a $400,000 business for them and have the landlord carry half on a note, which can be paid out of the proceeds of revenues of the business, if the business can sustain itself. So you are opening a whole, set of different options if you are doing this right. How much money do they have? Can they qualify for a loan, and so on? Financial statements and credit reports, just like with anything else. How soon does the buyer want to buy the business? Are they just looking to buy a business in the next 7 to 10 years, or are they looking to buy now? The FICO score and all the credit reports of the client. How long has the buyer been looking for a business? If they have been looking for a long time, are they ready to buy now, or just continuing to look because they were fired by the previous guy that looked for them? Does the buyer have reasonable expectations of business ownership? Very critical piece of information. A lot of people want to buy a business that is open 24/7 without the initial thought that they got to work 24/7, or they got to keep their eye on it, at least for the beginning. So you got to open their eyes to whether that business is right for them or not. Does the buyer have an investment partner or mentor who can make a difference in the business buying decision? I can just break this big smile. Most people do. Unless you have got all the financials from that individual person, trust me that there might be the big chances that there is someone else making a decision for them and bringing the money in. So if they don't prove the funds, then the money is somewhere else, and that person is the person making a decision. I just recently had a young lady that was looking to buy a $300,000 business, or up to $300,000, and the money was with their parents. And if the parents are not the ones that are visiting or reviewing every single piece of information you're sending her, there's no deal. Period. All right. So make sure that's happening. What expectations does the buyer have on their income? What expectations do they have on the return on their investment? I've asked people, okay, so how much money would you expect to make in the first year? And they never gave it a thought. And then they said, well, as long as I make $8,000 a month, I'll be good. But the business they're buying has no potential of giving them that at the point when they're buying. So if they're not making $8,000 from the get-go, their drive and enthusiasm is going to fall down month after month. And with that going down, how do you think the income of that business is going to go? So those are facts of life. Not much you can do about it. But if they are not making money, the expected amount of money from the get-go, the chances of them doing that later is none or reduced. And finally, we go to the summary. We covered the buyers. Will demand too much of their time? Yeah, you can read these questions and answer them. And the summary: understanding the nature of the transaction predetermines the final outcome of your efforts. And that is definitely what being a professional is. So you got to be good about how you qualify these people. You got to have predefined sets of rules you will follow, so you do not bend them, because when you do, you will get burnt. Most of that information we will go really deep into, and not just cover it, but commit you to it in our Business Ops 102 course, which is a fee-based course, but we do teach you, those that decide to be professionals in this, on how to handle all these things in a professional manner. Use forms and questionnaires. Even today I use forms and questionnaires when I do qualify the client. Because even though we can think of ourselves as professionals and somebody that has done a lot of business, we might miss some very key or important things. So using those forms actually is a great tool to fill out the forms before you sign the listing agreement or representation agreement. Because as you fill them out, you have all the necessary things to fill out the listing agreements. As you fill out the questionnaires, you have all the necessary information to fill out the listing agreements, and never leave it to the seller or the buyer to fill the forms. You got to fill those forms out and have them just sign the forms. If you wait for them to fill it out, no go. When in doubt, it's always better to possibly refer your business opportunity to a professional than get involved with it. I'll tell you one thing. I've done all types of businesses, from manufacturing to wholesale to design and restaurants and bars, which I'm actually most qualified for because I love working restaurants, nightclubs, bars, and that's where most of my business comes from. However, if I am doing a deal on a business that I'm not comfortable with entirely, I will definitely bring in someone on board or refer it. Just recently we had a manufacturing plant in the valley that I didn't feel comfortable about doing. There was a lot of things that I needed to learn, a lot of contacts I needed to make to sell that business. Well, it was much wiser and better to refer it to someone who knows what they're doing. And I did. And I got paid once they sold that business. It took them 1.5 years to close the deal. I got a nice referral fee rather than working my butt off and not getting paid because I might have goofed, not done it right. So it's definitely better when you're not comfortable to refer it. Avoid the liability of learning and of making mistakes and the time of that learning curve. And if you're not comfortable with what you're doing, refer it. If you're comfortable with what you're doing, do it right. Okay, so for those who would want to learn better how to serve their clients, to avoid liabilities and close the deals and business opportunities, definitely sign into the Business Opportunities 102 class and learn all about it. Until then, thank you.